Hi everybody, I'm Steve McDonald and this is your IDE Weekend Wrap-Up. In focus today, look at what happened Wednesday in the stock market, stocks that are really cheap, agricultural ETFs, home prices on the rise, and Buffett comes around to my way of thinking about the market and the economy, and maybe one of the best slap in the face awards ever. I might have to do it first so I can get through it. No, I'll do it last. Wednesday was a real sharp stick in the eye, wasn't it? But if you consider how negative the sentiment has been for so many people about the country, its direction, the economy, I'm surprised it wasn't worse, to be honest. The fact is, the numbers for the past 6 weeks have been weak, but not terrible. We are bouncing off the bottom. In fact, the bottom I called last spring. I said about 10,400, and it would take an act of God to move us past that. And as I've said before, this type of selling is expected when negative sentiment rules the day. Bad news gets a lot more mileage than good. The way to make money now is to let the idiots, yes, let's call them what they are, they're money idiots, let the herd make their direction clear to us, then do the opposite. Right now, the herd's direction still isn't clear. Are we going back to 9,500? Are we going to 11,000? But it will show its true colors. Wait until you say to yourself, this is ridiculous during a sell-off. Then the herd is firmly in place and it's time to buy. Well, I could wrap this up in very technical, impressive sounding language, but that's it in a nutshell. Let the idiots sell at losses again and then buy. Now, what should you be buying? That brings up our next topic. Cheap stocks. Multiples don't lie. And we can buy very good companies with great earnings for 1970s inflation-adjusted prices. That's right. Cheap companies, lots of them, many of them on the buy list in the sound profits, with big dividends, 5 and 6%. I have one in there at 10%. That's one I'm thinking of, and they're really cheap. That's how to ride out this current insanity about a double dip and deflation and all of this stuff that isn't going to happen. Now, after this settles down, and it will, you can go back to losing money in the risky small stocks. It's up to you, but I'll stay with the big safe stuff. Now, speaking of deflation and inflation, yes, again, Warren Buffett has finally weighed in on the issue, not with words, but with actions. Warren, as all informed people know, believes the real threat is inflation, not deflation. Deflation may be a short-term problem. I don't think it will be. It could be. But inflation is guaranteed as a long-term killer problem. So what's he doing? He's buying short-term, high-quality bonds. Sound familiar? I've been telling you guys to do that now for over a year. Why short-term? Because when inflation kicks in, or in an inflationary environment, they don't go down much and they still pay as promised at maturity. Look back at last week's IDE video where I listed the chart of how much 2- and 5-year bonds go down as compared to longer maturity 10, 20, and 30-year bonds. You get a 2 to 5% drop in value versus a 24% drop in value. And in the bond trader, we're earning between 8 and 10% on high-quality, short maturity bonds that will survive the inevitable inflation that's coming and still beat the market. In fact, we've been beating the market for the past 2 years while most people are out there playing the Wall Street guessing game of which stock hopefully won't kill me today. Now, there are choices to be made in investing, and most people are making all the wrong ones right now. Warren, what took you so long to figure out the inflation problem? Next up, home prices. Home prices rose in 100 of 155 metropolitan areas last month. San Francisco and San Jose saw a 25% increase, and Akron, Ohio saw a mind-numbing 36% increase in home prices. What's going on in Akron? If somebody knows, would you please tell me? I'd like to share it with everybody who tunes into these videos. Now, most analysts feel this will drop off in the next few months, this price increase, because the stimulus money has run out. But remember, most analysts have been telling you for months prices wouldn't move up at all. Well, so much for analysts as far as home prices. Housing has bottomed, and I'm saying it again, build your position in the home builders now. This is a waiting game, I know, but if you're positive on this, you will win. Next up, agricultural ETFs. Food, namely wheat, corn, soybeans, they've been all over the news lately. The Russian wheat embargo has really thrown things into a tizzy. As I said in an earlier piece here at IDE, looks very much like 1974-75 with food prices shooting up and oil running up. But there may be some money to be made here. Now, as wheat runs up in price, corn will be the choice for feed. Now, that's feeding cattle, not feeding people. That means higher corn prices as well as high wheat prices. See how it all cascades from a single event? All we needed was one little trigger event, and then things start to go crazy. Food demand worldwide is rising, and prices are moving up. Take a look at the agricultural ETFs. There are several to choose from that focus on grains, soybeans, sugar, even cattle prices. Now, I'm far from a commodities expert, but this looks like a reasonable play for this year and next. And finally, as promised, one of the best sound slap in the face awards I've seen yet. It goes to Morgan Stanley this week. You're going to love this. It seems Morgan Stanley sold an investment back in 2006 that was backed by investment-grade bonds. That's what you're investing in. Those are the good ones. One of the particulars of this deal, though, was that if the bonds in the portfolio dropped below investment grade, they were to be sold to cut any losses. This was designed to be very conservative for people who didn't want the risk of junk bonds and wanted an exit strategy if things went wrong. Makes sense, doesn't it? Yeah. So around comes 2008 and 2009. Bonds were being downgraded left and right. And the bonds in this portfolio were no exception. They were downgraded to a double B or double B minus. I can't remember which. Now, which is technically below investment grade. And they were supposed to be sold to limit the loss. That's how it was set up. Except Morgan Stanley waited 5 months to sell them, and the investors involved lost 80% of their money in the process. But this is going to kill you. The buyers of the bond, when Morgan Stanley sold them, Morgan Stanley bought them back. Okay? So Morgan Stanley bought their own bonds back from the investors. So the investors are out 80%, and Morgan Stanley paid 48 cents for these bonds, and 5 months after they were supposed to have sold them to cut their investors' loss. And since then, Morgan Stanley has doubled their money in these same bonds. Wait, it gets better. The people who lost the money, the people who trusted Morgan Stanley to get them in and out as promised, are a bunch of nuns in Ireland. And they're out $7.9 million. This is the money they use to pay all their bills, to, everything they do. Now, the nuns involved, and this is too much, the Holy Faith Sisters, Sisters of Charity, and Sisters of Jesus and Mary. And they want their money back. They say they were cheated by Morgan Stanley. It sounds like they were. And believe it or not, Morgan Stanley is fighting this. Is somebody there on drugs? They expect to take a bunch of nuns in front of an arbitration panel and convince the panel that the nuns are lying and Morgan Stanley really did do what they were obliged to do. Help me, this is getting too crazy. There's too many happy hours at the Morgan Stanley legal department. This is unbelievable. See you next week. Have a great weekend. For everybody here at IDE, I'm Steve McDonald. Thank you for being a part of us.